one, I want to talk about the YC experience, but mostly venture capital as a whole. And I feel like we can get into technicals with your background too. And address a couple of misconceptions. And I'll go through them one by one and we can talk through it. And I think the first misconception, and I get that I just talked about how much opportunity there is in America, but there's this lottery ticket fantasy about startups, and people hear a story about someone who put $20,000 into a pre-seed round of what became a unicorn, and they think that's the game. Just find the right company early and you're a billionaire. But what that story leaves out is everything that happens between pre-seed check and the exit, which is that every single round of funding essentially dilutes an investor. And it's not necessarily just an invest and hold for a decade and boom, you're a billionaire. But a $20,000 check buys you, say, 1% of a company at pre-seed. Then the company raises a seed round and you get diluted to 0.8 with a typical 20% depreciation. And then let's say you go to Series A, that's another 20%. You're at 0.6, Series B, C, D. And then you open up employee option pools, secondary transactions. And by the time the company goes public, your 1% is pretty much reduced to something that's probably going to return something on your investment at that scale, but not necessarily what people hope for it to be, especially for companies like Stripe, who have been private for close to a decade now and raised rounds at such large magnitudes that reinvestment on a pro rata basis is exclusively reserved for these incredibly large institutions. And another key point is that you've also got to understand that the venture capital market is riskier than private equity. It's riskier than stocks. It's riskier, way riskier than bonds or any treasury bills. And venture capital investment is usually reserved for high net worth individuals, not necessarily for an exclusivity point, but rather because your investment almost certainly will go to zero, except for rare cases. And say a venture fund invests in 10 different companies, more often than not, it's one company that's going to return the other 9 companies going to zero. And that is a huge risk that an unsophisticated investor that can't necessarily afford to lose $250,000, they just shouldn't be taking that investment. So what exactly is your take on this lottery ticket fallacy, and where people just hope to invest in SpaceX now and just hoping to become a billionaire overnight?
Yeah, so there are two sides to the coin, right? So we'll talk about it from the investor point of view and then from the point of an operator. Operator, in this case, would be the person who is running a startup. And from the investor point of view, actually, a lot of these angel investors, they, like you said, this is not their full-time thing. This is not where all their wealth is, right? Like for them, these are like moonshot opportunities, and they invest with the mindset that, hey, if I lose $20,000 tomorrow, would I be ruined? And if the answer is no, they're going to invest. And a lot of them kind of take like a systematic approach to it. So like the angel investors within the YC community tend to be previous YC founders. So they believe in the brand a lot. Secondly, they tend to pick verticals that they are very strongly, like they have good, deep knowledge about. So they're not like throwing money randomly. Whereas when you look at VCs that invest exclusively at seed, pre-seed, Series A, they're a little bit more haphazard than the angel investors, because they have a lot more assets under management for them to throw around and mess about. So they have a little bit more of a spray and pray kind of tactic. And they kind of try to narrow that spraying, being like, oh yeah, we have VCs that focus on deep tech or AI or whatever, and they just pick like a generally broad angle. And you're right, when it comes to investing in stuff like this, it's usually 1 out of 100 investments that pan out. And when they pay out really big. And every time you go from the more stages of funding you go as a company, the more vetted out you are. And then less of it becomes an art and more of it becomes a science. So for pre-seed, seed, and to an extent Series A, these are just based off of, do I believe in the team? Like, do I have conviction for the way this guy talks and operates? Do I have conviction of his background to deliver something of this scale or this particular idea? But post coming towards Series A, now it no longer matters about who you are, where you went to school, what you did, what your work experience is. Now it just becomes hard facts. How much is your annual revenue? How much is your burn rate? How many pilots, how many contracts? Like, these buckets just change depending on what sector you're in, right? So for enterprise customers, enterprise-based startups, for them, it's how many pilots they're running, what's their annual ARR. Whereas for like a consumer app, you're more concerned about your monthly recurring revenue and your retention rate and how many people spreading the word and distribution and stuff like that. And then more you progress, now you have more numbers to add and more numbers to add. So now the investors are just looking at numbers and running mathematical models, so less risk, hence the payout at later stages become more and more less, right? Because each stage, like the number of YC companies from our batch that still operate after a year and a half, maybe two, is probably around the 50% mark. Like, if I was to guess, like half of them just stopped doing that thing and went back to their back to their old jobs, or decided to go elsewhere or start another company. That's that. But from the operator side, right, angel investors are literally our lifeline, because when it comes to investment, it is essentially, if you don't set a deadline, this is why YC is so great. There's this whole notion of demo day, and investors have till demo day to decide if they're going to fund in money or not for this batch. So there's this looming deadline on the investors where they're like, cool, we have to make a decision on 200 plus companies and see which ones we want to invest in. And that forces people to go on heuristics. Sometimes you don't have enough time to see if this technology will distribute itself, especially in deep tech, as far as it is or whatever. So you have to not depend on heuristics. Where did these people study? Did other smaller investors hedge on them? And that's where the angel investors come in. So we take like a systematic approach. We start out and target as many angel investors as we can to build conviction, and then build intros to smaller, medium, and larger size VCs, and we go in that order. So for us, even though it's risky for an angel investor to invest, we need angel investors to invest, because that's the only way we can get momentum going to convince the other rounds. So the more angel investors we have at the beginning, much easier is it for us to convert the other VCs and then get those big checks, and the ones who are like, you know what, we're going to lead you around, et cetera, et cetera. But yes, it's risky business. It looks like you only hear the success stories, you never hear the failures. But the reality is, it's a numbers game. They know that it's a numbers game. So they invest wide and far, and then they have a few that really make up for all the losses and then some.
Right. And it was really interesting that you mentioned deadlines when it came to venture investment, because that was my next point, which is the misconception about runway. And as far as I understand, a standard YC deal is 500,000 with 125,000 that converts into a fixed 7% equity stake, if I'm not mistaken. And the remaining 375 goes into an uncapped safe with a most favored nation provision, which basically means that it converts at the best terms offered by any other investor on your next round. And does YC reserve pro rata rights to participate in every subsequent round?
They do.
So that feels like a pretty clean deal for founders. And is that consistent throughout for every operator?
Yeah, it's a pretty bog standard deal. And the best part is, they don't break up the payment into 125,000 and 375,000. They just give you the 500,000 up front, even though it's broken into those two terms, but your bank account gets hit with a single wire of $500,000 on day one. So having $500,000 in your bank from the get-go as soon as YC starts, having that kind of capital flow for, especially an international, like I would gladly give up 7% and then maybe 2% more depending on the valuation, just to have legal advice that'll get me set up with everything in the US, from immigration to running, like getting the company set up, having the network to start finding our first initial customers, and then just expanding the network. Like, if you really want to be in this space as an international, having applied everywhere, this is the best deal you would possibly get, and the brand recognition. valuation, right? It's so
Yeah, and two
like
things when this comes up. Firstly, being mainly for an international founder, you need incubators like Y Combinator to essentially provide you with work authorization without H-1B requirements. And you also don't necessarily enter these tech markets in Silicon Valley with existing networks. So a place like Y Combinator would essentially give you the accounting, the marketing, the legal side of the business and structure you in a very specific way that enables founders to focus on the product without necessarily burying you with too much admin work. But what is surprising to me, and I didn't know this before now, is that YC doesn't give you guys a term sheet with certain thresholds to meet to unlock funding. Is it all just given to you at once? That's quite impressive. But I guess conventionally, and I guess this is the second misconception I wanted to touch on, is that people think getting funding is the extremely difficult part. But from what I've seen with a couple of my friends raising, getting funding is super easy. The hard part is managing what comes after you get money. And that's a term sheet, which is non-binding, but outlines conditions under which an investor will fund you. And that could be valuation, board composition, liquidation preferences, anti-dilution provisions, pro rata rights, like we spoke about before. And each of these terms is negotiated, and each shapes how much control you retain and how much upside you actually capture at an exit. And a founder who doesn't understand this, or an investor who doesn't understand what broad-based weighted average anti-dilution clauses does to them in a down round, is walking into a trap that they don't necessarily understand until it's too late. And I feel like there's two sides to this, but to me, it feels like it creates this runway problem where I'm assuming YC recommends raising for 12 to 18 months of runway, if I'm not mistaken. Yeah, so enough to build, test, and hire. But what the medium wait times between rounds now indicates is almost 3 years. So is 18 months of runway necessarily enough at the standard YC practices? And also, it's the companies that are surviving the current economic conditions are the ones that raised longer runways and managed burn with a lot of discipline, right? They're not the ones that raised crazy valuations and hired aggressively, because we saw from 2021 where there was this massive overhiring, and I think that subsequently led to a lot of the layoffs of 2023 to 2025, and the money was real. The business underneath it, in many cases, didn't necessarily have the oxygen to breathe.
Yeah.
Any thoughts?
Yeah. It is, I think the YC mantra is survive. And you just want to spend enough capital and money to maximize your chances of survival. Because when you're coming in at especially pre-seed and seed money, you have to be kind of malleable. You have to be able to kind of, sure, you need to have an opinionated approach, right? That's why, like people are like, yeah, we're going to back you. But within that opinionated approach, you need to be quite versatile, being able to swap and build on ideas as much as possible. And the best resource you can give yourself is time. The more time you have, the more you can ideate, more you can iterate, and hopefully you will hit on something that'll catch on like wildfire. Then when it comes to how much money you should raise, that also depends on what your R&D cycle, the duration of which that R&D cycle has to exist. So if you're in deep tech, so building space applications or frontier robotics or biopharma, for that, the R&D costs are quite high. So obviously there you need to raise massive war chests, and like bigger your war chest at minimizing dilution as much as possible will probably ensure your longevity. Across all of that, the discipline comes down, like the general principle is how much time can you buy for yourself? There's two ways to do it: bring down your burn and increase your war chest. And you just have to pick which one would be easier for you to do at your given point of time and what sector you're in. So going back to that deadline of demo day, right? because all these investors are operating with limited information. They have this fear that some other investor will hop in at a lower valuation or get better rates or be able to negotiate a board seat or whatever. So there's this pressure now for all these investors to kind of just go ahead and give you money. So demo day around that time is also a great time for you to increase, to have as big of a war chest as you possibly could, because that kind of attention and that kind of very quick due diligence processes only hover around demo day.
So you'd say having a bigger war chest outweighs the risk of raising too high of a round and not being able to meet certain thresholds in your term sheet and running out of runway.
Correct. So in the cases of raising seed stage funding, right, a lot of the seed deals that we saw within the community, like they didn't have explicit performance criteria to be met to unlock more funding. So at that seed stage, if you can raise a bigger war chest, you're good to go, but within reason, right? Like there's no point in you raising so much, because that is also your most expensive round for you as a founder, because you have to give up so much of your equity. So it's a balancing act. Series A onwards, you have that performance criteria come in.
I guess I was looking at OpenAI mostly as a case, as opposed to seed companies where their last round closed at $800 billion, and they're eyeing an IPO with a valuation of 1.2 trillion, but there doesn't necessarily seem to be that much demand for a $1.2 billion valued OpenAI, when there doesn't necessarily seem much interest in the $800 billion valued